Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
You're listening to the Macro Brief, the podcast that looks at the issues driving financial markets across the globe. This episode was recorded for publication on the 4th of September 2025 by HSBC Global Investment Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And remember to like and subscribe to the Macro Brief wherever you get your podcasts.
Hello, I'm Piers Butler and welcome to the Macro Brief. I'm here in our London studio, and this week our focus is very much on the UK, where the economy remains firmly under pressure. Inflation is sticky, gilt yields have been heading higher, and the public finances are in a precarious state. Tackling these issues is an unenviable job for Chancellor Rachel Reeves. So with the autumn budget fast approaching, we're looking at what options she has available. And to do that, I'm joined in the studio by Liz Martins, Senior UK Economist. Liz, great to have you back.
Hi, Piers.
Not necessarily going to be an easy conversation because it's, as we're recording this, it's been another turbulent week for global markets, and the UK is very much in focus. I saw this headline earlier in the week that UK 30-year bond yields had risen to the highest level since 1998. So I guess the market continues to be concerned about the UK's fiscal position, or to put it at an even simpler level, the level of government debt. So what's precipitated the market's concern? Is it just that everybody's back from the summer and reminded of the fact that government finances in the UK are not in a great state?
Yeah, I think it's partly that. I mean, actually, these are globally driven moves. So we do see bond yields up around the world. But of course, the market always focuses in on the UK. I think there's a number of reasons for that. One is actually just the memory of what happened in 2022 and the gilt crisis around the mini budget. That's one of them. I think the UK has a particular inflation problem at the moment, which means that, a lot of expectations that interest rates aren't going to come down as quickly as maybe had been thought a couple of months ago. You've got the fiscal issue, which we're going to talk much more about, but essentially concerns about what's going to happen in the budget in the autumn. And then the final one for the gilt market is simply that, one of the traditional buyers of gilts, the pension fund industry, is buying a lot less than it used to. So there's a less stable kind of investor base. So, I mean, look, the market is still functioning well, right? We've had an oversubscribed issue, this week. So I don't want to be over alarmist, but, gilts are rising and that causes problems.
So is the crux of the problem that the government's room for manoeuvre is very restricted? Why is that? And can they not just borrow more or raise taxes?
Well, look, I mean, because the market is nervy and is demanding this kind of high risk premium on gilt yields, what they are asking the government to do is show the market that it has a plan for keeping borrowing under control, that it's not just going to rise and rise and rise. And the way the government expresses that plan is saying, well, look, we're going to meet these fiscal rules and we'll do it with this much headroom. As you say, the problem here is there's very, very little of that headroom. So in March, when Rachel Reeves last updated us, she left a tiny sliver of just £10 billion against the target. Sounds like a lot of money. It can blow away with the wind very quickly, and indeed it looks like it has, and then some. So can you just borrow more? Well, you can try, but the market is going to penalise you for that through higher yields. And of course, people are nervous, not just of higher yields, but of something a bit more disorderly, like what happened in 2022. And then why can't we just raise tax? Well, first of all, taxes are already forecast to rise to the highest level as a percent of GDP since the Second World War. There's a lot of negative noise feeling around that. Of course, companies felt the hit of the national insurance rise from last autumn budget, and we still hear about that a lot from our corporate clients. It's still a big deal for them. But then the other problem with it is that actually the government has promised not to raise taxes which make up 75% of the revenue base.
Which are?
Right, so that would be income tax, VAT, national insurance and corporation tax. Those are the ones that the government has said, we will not increase the rates on these. Now they can do things like, for example, freeze the income tax threshold, which Rishi Sunak did before them, and maybe that will end up happening, and maybe people will say, well, that is an income tax rise, really. But it's very hard to actually just go out and say, do you know what, we're putting a penny on income tax. And when you are not raising those taxes, it just makes it really hard to raise any kind of meaningful amounts of money. So it's really tough. And that's why the market's worried, because they're wondering, how is she going to make these numbers add up?
And indeed, there's a bit of a deadline here because there's an autumn budget.
Yeah.
And what are we saying that, what room for maneuver does she have to do anything within that budget?
It will really depend on the numbers that the Office of Budget Responsibility present her with, and I think we'll do some more calculations on that when we get a bit closer. There are a few things to take into consideration. One is the government tried to cut spending in the spring budget. Well, they tried to cut the winter fuel allowance, of course. They tried to cut disability benefit. Those things have had to be reversed due to political pressures. So that's headroom that we did have that's gone. Then you've got the cost of higher gilt yields, because as gilt yields rise, we're paying more interest on the national debt. So that also subtracts from the headroom. And then the third one, the big unknown that could be a huge story, is what the Office of Budget Responsibility decides to do around its productivity forecast, because the OBR is a productivity bull, actually. They think the productivity is going to pick up in the UK, and that will bring revenues, and that will provide some of this headroom. Now, if they revise that away in autumn, then she's got a really big problem. So what can she do? Depends on the size of the problem. If it's a small problem, she can tweak it, with things like, I don't know, there's suggestions on gambling tax. There's, that frozen threshold. There's lots of things going around in the press. If it is a big, tens of billions of pounds, it may be that some of those manifesto promises can't be kept.
So you wrote about this in a note, in fact, that you co-wrote with our head of UK rate strategy, Danny Russell, summarising into 4 scenarios. How do they play out? Are they all very bearish, or there's some good news here?
I'm afraid none of them are very pretty. Look, probably the best case scenario is that the OBR is the forecasts are favourable. So they don't revise down productivity. They keep the faith. There is a relatively small black hole against the targets, and she's able to kind of stick a few plasters on it and muddle through. That does still leave us, in a precarious position, because 6 months down the line we could be here again, but we'll have got through that hurdle. Our second scenario is that they present her with a much bigger black hole, but she deals with it really realistically. So really rip the plaster off, big tax rises, but at least leave the UK in a healthier position, more headroom at the end.
Which the markets, I guess, would like.
I think the markets would like that. I mean, there's always the risk that, the risk of implementation, can it actually happen? The risk of slower growth. There will be worries. But yeah, I think on balance, the market wants to see that headroom restored. The third scenario is kind of similar. There's a big black hole. She raises taxes, but it's all got a feel of fiscal fictions. We'll borrow more in the next 2 years, and then in the target year, we'll have this big, consolidation, frozen spending, more tax rises. We'll sort it all out in the target year. And the risk with that is that the market just doesn't believe it. It's fiscal fiction. And then the fourth scenario, and I have to stress that newspaper reports suggest she won't do this. All the newspaper reports suggest she is sticking to the rules. But the worst scenario, I think, from a market perspective, is she doesn't stick with those rules. She says, I can't make these numbers add up. We're going to have to change the rules. And that's the one I think the market would be really unnerved by.
Because I suppose it would sort of lose the discipline that at least is still there.
Yeah, exactly.
In an earlier report, you looked at the 60 key charts for the UK, where you highlighted that our labour productivity continues to be weak. It has been a sort of persistent problem in the UK. So if we're trying to look at some positives, could AI start to make a difference? It seems to be starting to happen in the US. I asked this question because I read the note by our emerging market and global equity strategist, Alistair Pinder. He wrote highlighting that AI could potentially reduce S&P 500 operating costs by around 1% in the next couple of years. Can we see some of that good news come into the UK?
Yeah, I mean, look, we've been looking for productivity for a long time. We've been disappointed on multiple occasions, but AI does feel like something really different coming along, doesn't it? And I have to say, when we talk to our corporate clients, we hear more and more of how they're using it, for example, in marketing and in sales, and AI doing the work that, would previously have taken a week in a matter of, minutes. So clearly there are some productivity gains here. And of course, productivity is the holy grail. It's the thing that would hopefully, in theory, reduce inflation and generate growth and sort out some of that problem in the public finances. So we certainly live in hope and continue to look at that and monitor it closely.
You also highlighted in that report that monetary conditions were looser and starting to boost business loan growth. I mean, how significant is that?
Well, look, it's nascent. I think, bank rate has come down from 5.25% to 4% is the point that I was making. I know people are starting to think maybe it won't come down much more than that, and the market pricing's moved in that direction. But we have seen a significant loosening. Now, it hasn't done much for gilt yields, but it's brought mortgage rates down, and we're starting to see, for the first time in 4 years, SME loan growth in positive territory. So we'll keep an eye on it. But again, it is a positive sign. And it's not the only positive sign, actually. We've had a few more recent positives. I think the services PMI was up, quite a decent reading. Mortgage approvals were up in July. And consumer confidence a tiny bit up. So nothing spectacular, but just some slightly better bits of news out there.
So maybe just to recap, we come back from the summer. There's obviously some concerns in terms of treasuries and treasury yields going up. But as you said, and I think it's worth reminding at the start of this conversation, the market cleared this week. It's not like we're sort of facing some kind of crisis and what have you. There are obviously concerns, but there is a budget coming through. And also, what is the Bank of England likely to do in its next meeting?
Yeah, so the Bank of England, of course, very cautious tone in its last communications. So it cut rates in August, but only by the narrowest of margins, 5 votes for a cut, 4 for a hold. And the message was, look, do you know what? Inflation is too high. We're not sure. We think the rate of travel the direction of travel is still downwards, but we're not sure, how much further or how fast to continue easing. So, the BOE is looking for evidence of continued disinflation, and maybe, with a slightly higher bar for cutting rates than has been the case of late. The other decision they've got to make is around quantitative tightening, and they will announce that in September.
What does that mean?
Right, so the Bank of England is reducing its portfolio of all the bonds it bought through the various QE programs.
I wish you bought a lot.
Yeah, there was a lot. Yeah, exactly. And it's made good progress in reducing it. And part of that is actively selling bonds into the market. So it will tell us how much it's going to be selling in the September meeting. And our view is that, look, they might or might not reduce the pace of sales. But what we do think they'll do is skew the sales such that they are selling less at the long end, which is where the most acute pressures are in the UK market, and more towards selling towards the short end. And that could help the gilt market a little bit, just relieve a little bit of the pressure that at a time when, long end yields are under pressure, actually you don't want the Bank of England selling into that. So, maybe that will help a little bit. And if we get through the budget and it's not too bad, then hopefully the environment will be a little bit better thereafter.
When is the Bank of England meeting?
It's the 18th of September.
Well, I'm sure we'll be having you after that. But in the meantime, good luck keeping track of it all. And thank you for joining us today.
Thanks, Piers.
We're getting close to the next edition of our Live Insights on LinkedIn. Please join me on the 10th of September, where I'll be talking to Dara Ma, Head of Digital Assets Research, on the fast-growing world of digital finance. It's a great opportunity to put your questions to Dara. So if you want to know more about cryptocurrencies, stablecoins, or blockchain, then please join us next Wednesday. A reminder that if you're an HSBC Global Investment Research client, then don't forget to download our mobile app. The app features all our latest research, videos, and podcasts. You can find it on Apple's App Store and Google Play. And if you'd like to get in touch with us, you can do so by emailing us at askresearch@hsbc.com. So that's all from us this week. Please join us again soon for more insights and views on the Macro Brief.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.